Hi, everybody, and welcome to UFile's Facebook Live event. My name is Ida Celli. I will be your co-host today, and it's an opportunity for you to ask us your tax questions. So to answer these questions, we have my colleague, Jerry Vitoratis. Hi, Jerry. How are you?
Not bad, Ida. How's it going?
Pretty good. Busy, but that's okay. I think that's
Well,
part of our
it's going to be a busy
our
tax season.
season.
It's
Yeah.
going to be a busy tax season this year, that's for sure. With a lot of changes this year, right? Which we posted online on our blog website at ufile.ca. So we posted a whole list of the changes that are coming for 2023. So go ahead and view that page and go see all the changes that are coming, so you can benefit from these new measures from the government.
Actually, a few dates to remember. When is the last day we can uh, put in an RSP? Sorry for the deduction.
Today, that's it. You got till midnight today to contribute to your RSP to make it count for 2023. It's not March 1st. Remember that, okay? When it is a leap year, okay, it is always the first 60 days, which means it's February 29th is your deadline. So that means you really have to get it. You have to get it in by today. So you don't have to buy anything within your account. You just have to fund your account. And the moment you fund your account, that counts as a contribution. And at that point, you're ready to go. And then it'll be available for you for 2023. Because remember, the contribution year is actually really just the day after the first 60 days of the year until the first 60 days of the following year. Okay, that's essentially what your contribution period is. Okay, so the key is make sure you contribute. You got till today, and again, you don't have to buy anything. Just deposit money into the account, and you're good to do. And you're good to go. Well,
All
I
right,
think
people,
Lana
you
says
can
hello.
ask us your questions in the
So Lana,
comments.
hello as well, from us,
Oh,
we're
from
from
she's
Montreal
Alberta.
actually. Yeah, she's from Alberta. So welcome to the session. If anybody has any questions, don't hesitate to go ahead and ask away. We're going to do the session for about an hour, right around about. We might go a little bit above an hour for the session, depending on how many questions that we get. If we can't get to all your questions, we will answer directly in the chat. But go ahead, since we're already live right now, go ahead and ask any questions. So let me see. I think we already got our first one,
Teresa,
huh? So Teresa has already got the first
is
question. What is
what
the
is the
difference between?
difference
Yeah.
between the form T777 and T2200?
Okay, well, they're both related in the sense of they're related to employment, what we call employment expenses, which are expenses you can deduct off of your employment income on your tax return. The T777 is the form that you make the claim for your employment expenses, whether it's home office expenses or whether it is other types of employment expenses. If you are, if you have to incur these expenses and your employer doesn't reimburse you. The T2200 is the certificate form, or what we call the conditions of employment, that essentially allow you to deduct your expenses on the T777. You must get authorization from your employer. In other words, your employer has to confirm that as part of your work contract, you've engaged in expenses that they have not reimbursed you for, whether it's home office expenses, which is a typical example, or other type of expenses that you can claim in employment expenses. Okay, so T777 is the form you claim the expenses. The T2200 is the form that allows you to claim the expenses. Essentially, your employer has certified that as part of your working conditions, you are spending money out of your pocket in order to work, essentially, and they have not reimbursed you.
Okay, the next question is from Devin.
Mm-hmm.
My wife and I separated on October 20, 2023, less than 90 days before year end. Does
Yeah.
this mean, whoops, sorry. Does this mean we have to file taxes together for 2023, or is there a way to do so separately? If so, can you outline how it's done using UFile?
Mm-hmm.
And then additional question, if we do have to file together, my ex-wife's son turns 21 in March 2024. Because he was 20 for the entire year of
Yeah.
2023, is he still considered dependent, or does that eligibility expire at an earlier age?
Okay, so Devin, first things first, that the 90-day period can go over 2 calendar years. It doesn't have to be that you have to meet the 90-day require. Remember, the 90-day requirement is you basically are officially separated past 90 days if you don't reconcile. Okay, within those 90 days. So if you separated October 20th, you wait 90 days to make it official. Okay, and once you pass the 90 days, then your separation date is October 20th, 2023. Now the 90 days again doesn't have to be in the calendar year, meaning that basically you've already crossed over those 90 days. Okay, so that means that for 2023, you are filing as separated. Okay, that's how you would file. All right, now in you file, what you would have to do is you have to remove your spouse, okay, from within your family file. Okay, so if you're the file head, if you're the family head in this case within you file, then you have to basically delete the file of your spouse. Unfortunately, there's no other way to uncouple. In this case, in you file, you have to remove your spouse, and your spouse will have to create her own file. Your ex spouse will have to create her own file separately. Okay, so within if they want to use you file or something else. All right, so that's how it would work. All right, now, so I think I answered that question. So your ex-wife's son turned 21. Well, he was already ineligible for the eligible dependent, because eligible dependent they have to be less than 18 years old at one point in the year, which they don't meet that criteria. The only way you can claim a dependent if they're over 18 is if they have some sort of infirmity. Okay, in that case, not necessarily a full disability, but basically what we call an infirmity. Okay, meaning that they have some sort of physical difficulty in this case.
And they asking, can they split the scholarship? No, can they split the scholarship using U file?
The scholarship that the son received, the scholarship income, because that would be in your son's return. It would not be. Or are you talking about the tuition fees? Maybe tuition fees cannot be split. Actually, usually it's one or the other that has to claim it, because on the actual T2202 or T2202, as we call it commonly in tax circles, there's only one name that can be assigned. Okay, on that form. So basically, you would have to choose who would claim that transfer amount.
Okay, sorry about that. I think because I'm flipping between
Oh,
screens.
I think okay, it's
yeah,
Natalia
it's
actually.
Natalia's
Okay.
question.
Oh,
She had
sorry about
for
that. Yeah.
2022, she had a hello,
Mm,
2022 T4A line 105 scholarship, $10,000. T2202 part-time student, academic year 2023, and
yeah.
tuition was 5,000 as per the form for part-time enrollment. She started
Yeah.
university in January. Would she
2023.
be able to transfer 5,500 to 2023 tax year to exempt from taxes and pay tax on 4,500 in 2022 tax year? How can I
You
split?
can't.
Okay.
No, you can't split the scholarship. No, it's whenever you receive the scholarship income is when you have to declare it. Okay, and since you were a part-time student and you started, you say in 2023, and you only have now the question is, were you a full-time student in 2023? If you were, then you could get the full exemption of the scholarship income. But if you were not, if you're still a part-time student in 2023, then for 2022 you could only get a $500 exemption in this case. That's all you can get, and you can't separate that income. It's when the income was received that you have to declare it. There's no way you could separate it.
Okay, now we're going to go to Carol.
Okay.
I am disabled and have had to hire a cleaning company for house cleaning. Can I claim this cost as a deduction?
Not unless you need it in order to work. Otherwise, no. You will not be able to. You can claim disability amount. You could claim certain additional medical expenses, but beyond that, you will not be able to claim like house cleaning, for example, things like that. You could claim, for example, attendant care expenses as a deduction, or even as a medical expense, but it's got to be attendant care. It can't be just cleaning the house and things like that. It's got to be something where the person is physically helping you. That's the only thing you could really claim. Beyond that, unfortunately, you can't claim anything else.
Okay, next question is from Jason.
Hmm.
Under the interview, dependents, the net income for T1 line 20, that's what his question is
Yeah,
for
yeah.
line T
My
23600.
son did not
My
earn.
son did
Okay.
not earn last year and I have entered zero. However, if I delete the zero amount, it reduces my calculated return by nearly $2,000.
Okay. So in the interview, dependents net income for T1. My son did not earn anything last year, and I have entered zero. However, if I delete zero, the amount it reduces my calculated return. Yeah, Jason, we'd have to see the file. I don't know why you would do that. Basically, what you would have to do in the dependents file, you don't enter zero. What you would do is in the dependents file, you would tick the box that says that the dependent didn't have any income for the year, and now you would do it in the interview setup. So you would go into the interview setup section of your child, and then you would tick for your son. You would tick the box that says they have no income, and at that point, the program should claim whatever amounts there are to be claimed. Now, beyond that, unless I could see the file, there's no way I could really answer why you're getting this different calculation. We'd have to look at the file. The best bet is to contact their support staff at help@ufile.ca and send them that question. I would recommend going through the product and sending them a copy of your file. Okay, and it's anonymous, by the way. When you send us a copy of your file, we don't see the names or the SIN numbers or anything. The program scrambles everything and then just sends a copy to us, and then we could view it and explain to you why you're getting what you're getting.
Okay, next question is from Cheryl Lynn.
Mhm.
Cheryl, sorry. Thank you for doing this Q&A session again this year. You're welcome. My husband's T4 has an amount in box 38 RSUs for his employer, which has vested and now
Yeah.
are his. I understand this amount is already included in his T4 box 14 as
Hmm.
income. My question is, should this be reported in any way anywhere else on the return for 2023 or not until a later year whenever they are sold? He has kept the stocks and not sold them.
Okay, so since you have not sold them, you don't have a capital gains transaction. Okay, so what you're talking about is stock option benefits, is what you have, is what your husband has in this case. So essentially, these are options that they can, exercise in order to take possession of the stocks, and that's essentially what he did, and that's why you have a box 38. What you need to check for, Cheryl, is that you might be eligible for a deduction of that amount. Now, it's not necessarily guaranteed because the government made some changes to these rules to the stock option deduction years back. I can't remember offhand what they were, but I remember there was some limiting factors now. Whereas before, you could simply claim a 50% deduction on that benefit that is included in box 38 and of course in box 14. Make sure your employer should already have that in there. Just double check if they don't have a box 39. Okay, if your husband doesn't have a box 39, there's nothing else to do. You simply have your box 38, and then the only other time you're going to declare anything is when your husband sells the shares. Okay, but just double check to see if they have something in box 39 which will represent the stock option deduction. It might not be the case because the company might not be eligible to assign a stock option deduction because of the recent changes the government made to stock option deductions. Okay, so just double check, just so you make sure you're not losing out on a deduction that your husband might be entitled to. So check if he has a box 39.
Okay. In our feed, Spare Lee, his question is further down, but I can see it. Do you want to take it right now, or are we gonna come back to him?
Um,
He has a
yeah,
question
I got
regarding
it.
the
I got it. I found it. I found it.
Okay,
Okay. Yeah.
LTC fee questions.
Yeah.
My disabled wife 2023 income is 17,876, and
Okay.
my income is
Comes
110,000, mostly from pensions.
yeah.
In the past year, I split pension with her and made her income up to 15%
Yeah.
to
Of
reduce my
course.
taxes. This year, she will enter long-term care home and the fee is 80% of her after-tax income. How much should I split to her so as to save most of the fee and tax? The 15% is
Okay.
the max is 53,359.
I mean, you can still split. I get what you're trying to do is you're trying to maximize the medical expense claim is what you're trying to do. Remember that medical expenses is a non-refundable tax credit, which means that if you keep her income too low, then the medical expense won't have an effect. Okay, because any excess credit you get on the medical expense credit, you can't recuperate. Okay, you can't recover because medical expenses is a non-refundable tax credit, which means you're reducing tax to zero, and then any excess amount is simply lost. Okay, when it comes to medical expenses, just let the program do its thing. UFile will optimize this type of situation for you. There's no need for you to really play around with the split between each other. The program should figure this out on its own and give you the best result possible.
Okay,
Okay,
next
so I'm going to
question
go
comes
back up.
from Jonathan.
Okay.
Okay, is a withdrawal from RESP taxable? An amount was withdrawn in 2023, but the student did not start school in January 2024.
Okay, so Jonathan, yes, the withdrawal is taxable, but it's taxable in your child's hands, not in your hands, the one who made the contributions. That's the beauty about the RESP, right? Is that you contribute to it. It's tax sheltered. The government gives you a kickback of 20% for every dollar you put in every single year, up until I think it's 2,500 is the max per year that they give you the kickback essentially, or what's called the grant. Okay, and at that point, when they withdraw from the account, any gains from the account are taxable in the child's file, but any original contributions are not. Okay, so that's the beauty about the RSP. That's why it's so beneficial. Now, if they withdrew in 2023, there might be some penalty because ordinarily you're only allowed to withdraw when the child shows proof of being a student in a post-secondary educational institution. Okay, so if they don't have that proof, then it's possible in that case there might be some sort of penalty that might be paid at the time of withdrawal. But otherwise, it won't be. It's just going to be taxable income in your child's file. And your child, of course, would not have a lot of income on their return. Therefore, the tax rate would really be minimal on that income.
Okay, next question is from Teresa. She
Mhm.
has two. So, can we claim paralegal fees when we have them as a result of appealing a WSIB decision? And where do they claim the repayment of the wage loss replacement benefits? Sorry.
Okay, so the question. Okay, so if this is in order to collect income from, I believe that's workers' compensation, right? In the WSIB, right, or something along those lines. Let me just remember again what that acronym is. I'm drawing a blank. Um, Health and safety. Hold on, I'm just going to check 1 second. Yeah, WSIB Ontario, exactly. Yeah,
Yeah.
that's what I thought. Okay, so in this case, the answer is yes. If you're incurring legal fees in order to get your rights to those benefits, to those payments, then yes, you can claim legal fees as an expense on your tax return. It's a deduction. Okay, in this case, to appeal the decision. What was the second question, Ida?
Where do we claim the repayment of the wage loss replacement benefits?
Okay, so the repayment would be. Let me go 1 second. It would be in other deductions. Um, Simply, you're going to see a section on the left called other deductions. Okay, so you simply enter it there, and you would choose not additional deductions, sorry, other deductions for the line 23,200. So the section would be other deductions in UFile. Okay, it usually appears automatically for every single one of the files. You go in there and you put it on line 23,200, which would be the first option for other deductions, and plug it in there. Okay, that's it. And that's where you actually, by the way, you would also claim your legal fees as well. It would be in the same. It would be in the same spot as well.
Okay, next question comes from Shade.
Mm-hmm.
Okay, sold a property in 2023. I completed the capital gains interview section and it seems correct, but I'm not quite clear on how to complete the CCA portion. I have the UCC as the at the end of 2022 building
Mm-hmm.
only and the
Yeah.
total CCA charged since the purchase. Not
Okay.
sure where the land part of the sale comes into the whole capital gains calculation. I uh, I
I
have a
have a
separate
separate.
T776 for each property.
Okay, so for the capital gains, for the land, you would have to separate the transaction. So in other words, within UFile, you would have one transaction for only the building and one transaction for the land. Okay, that would be the best way of essentially inputting those amounts. Okay, but you could put both, to be honest with you, but you might run into, let's say you had a capital loss, for example, you might trigger capital loss when you're not eligible for it. Okay, so when it comes to the CCA portion, what you're going to enter in UFile is going to ask you for the disposition amount for the building. So you put in the disposition amount for the building only, and then you put the original cost before you took CCA. Okay, in the line just below when you're in the disposition area. Okay, so you have to go back and find out what the original cost was, which is what you computed for the capital gain either way. Okay, so you would put it there, and at that point the program will deter, and then make sure that you're liquidating the class. So within the program, towards the bottom of that section, you're going to see something that says, is this class liquidated? You're going to say yes, and then you're going to trigger a terminal loss or a recapture. It's likely going to be a recapture in your case for 2023. You're going to trigger a recapture in that case, and it'll be additional rental income on the return. Okay, so that's what you would have to do. So first, capital gains, enter the land, then enter the building. You can enter them as separate transactions, and then then within the CCA class, in the disposition area, you're going to enter the disposition amount and then the original cost before you took CCA over the years. Okay. And then you liquidate the class. You say yes to the liquidation of the class. And then you trigger your recapture at that point.
Okay. Next question is from Louise
Mm-hmm.
La Liberté. How to report relevant one employment income from taxable medical benefits from a previous employer, and she's retired. She has no employment income.
Okay, so then what you would do is you would go into the pension income section, and you would choose the T4A. So let me just show that real quick. Just give me 1 second. I'm going to hide you for 2 seconds.
Sure.
Here we go. All right, so we're going to show that. I'm going to hide Ida for 2 seconds, and here we are. So when you go to the interview setup, okay, so I'm in the Quebec file right now. You'll choose the section here, pension and other income, where it says pension income, etc. Tick the box next to pension income where the T4A is in this case. Click next at the bottom of the screen. And then what you do is you go to the new pension income section that's going to appear, which for some reason, oh, there it is, T4A. And then you see over here, you've got a T4A pension income with taxable benefits for the relevant one. So click on the plus sign next to that one, and towards the bottom completely of the screen, you've got your boxes A and your box J and your box L and any amount that you paid, for the insurance, and then the program will simply include it as employment income on the return. Okay, so it's just going to add it over. All right, so let's bring Ida back. And there she is. All right.
All right. So
Let's
we're
keep
going
going.
on, moving on to the next question. Viola,
Mm-hmm.
how can I file taxes for my 16-year-old? Or do I have to remove her as a dependent in order to do that?
No, Viola, you can keep her as a dependent. The program can produce the return for your child as a dependent. Now, whether she's required to have a return depends on if she's gained any income in the year. At 16 years old, she wouldn't be eligible for any benefits like GST, okay, like the GST credit. So because of that, the program might tell you that it's not necessary. UFile will tell you whether it's necessary or not. If she gained any employment income, if she made any income, for example, in the year, and she had any withholdings at source, then the program will generate a return in order to trigger the refund for her on her tax return. Okay, so just let the program do its thing. Keep Viola there as a dependent. If she has any income, plug in her income. If she doesn't have any income, simply tell the program that there is no income for the dependent. And then from there, UFile will tell you whether she's required to file a return or not. But if she is required to file a return, you can keep her as a dependent. UFile will handle the majority of the tax situations that it handles for you as a dependent as well. So there's no problem there.
Okay, next question is from Akbar.
Mm-hmm.
Contributions made to my company pension in 2023 will be deducted from the 2023 deduction limit from the
Yep.
2022 NOA or the new room created in 2023.
So what you made for 2023 will count for 2024. It's going to be determining for your room for 2024. So contributions you make and that your employer kicks in as well for every dollar that you put in will reduce your RSP deduction limit for the upcoming year, which is this year for 2024. Okay, that's how it works. Okay, so it's what the government calls the pension adjustment. Okay, so if you have the luck of being with an employer that has what's called a sponsored pension plan where you put money in and then they kick in a certain amount as well, then the combined amount that you put in that your employer puts in becomes the pension adjustment, which will come in to reduce dollar for dollar your RSP contribution limit. And at that point, this will affect your 2024 limit because it is the upcoming year so your 2023 notice of assessment is determining what you're allowed for 2024. Okay, so that's what it's going to affect.
Okay, he also has another question. We'll probably see it later in the feed, but can you
Okay.
show quickly when somebody does several slips, whether it's the T2125 or many T4s, how to go delete the extra slips you don't want?
Okay.
And you can
It's
show,
very
yeah.
simple. Yeah, it's very simple. So let me go in there. I'm going to hide dry it for 2 seconds. Okay. So over here, as you can see here, I've got my one T4A slip that I added before when I was showing the other client what's called how to perform something in the software. You see there's a minus sign right next to the slip. Okay. So simply click on the minus sign. It's going to ask you whether you want to delete this page. You say yes, and the slip gets deleted. Very, very simple. Okay. When you're adding, if you've added excess slips that you don't want there. Okay, so let me bring Ida back, and there we are. And Ida's
Okay.
back.
Next question from Sue Bruce Sanders.
hmm
Why would you file show that my husband owes zero for federal tax when he was reassessed and they showed an amount owing?
Well, Sue, again, without seeing the file, it's very hard to just answer that question off the top, So, again, for these kind of questions, you have to contact our support line, help@ufile.ca. It would be very helpful if you also submit a copy of your file with a copy of your notice of assessment. Okay, so that way the agent can do the comparative and see why there was a discrepancy between the government notice of assessment and what the program determined. Okay, so go ahead and contact. They're going to tell you how to share the file, and they're going to ask you as well for a copy of the notice of assessment in order to make that comparative.
Okay, next question is from Susan. Susan?
Mhm.
Okay, once I have downloaded the CRA information slips, if there are any new information slips added to my CRA file, will they be automatically added to my file account or do I need to download again?
No, you need to download again, Susan, just to be safe. The program will not auto update in this case. So when you download, if let's say you haven't gone into the file for at least like a week, let's say, or something along those lines, go back and just redo the download again. The program is going to ask you whether you want to just keep the file that's the download that was there, or you want to try it again. You go and try it again, and then you download the slips again.
Okay, next question is Devin. Appreciate the answer. In the U file form under marital
hmm
status as of December 31st,
Yeah.
2023, it provides the option married or separated for less than 90 days
Yeah.
and separated. Based on your answer, I would
Yes.
choose separate. Yes, you would.
Yes. Yeah. Because remember, Devin, again, the 90 days does not have to be in the calendar year. You understand? It can go over 2 calendar years. And right now, since October 23rd, you're well past the 90 days now. Okay. So you've already met the criteria, which means that now you are officially separated income tax wise. Okay. You are separated. So at that point, you choose the separated option. Absolutely.
Uh, Jason Moe, I'm not too sure if this refers to a previous question. It
Yeah, I
comes
think
up as
so.
a warning at the review stage.
Okay, but then put a thumbs up, so maybe it was answered in this
Okay.
case.
All
Okay,
right.
Spear, we answered. I think
Spear.
that was the one. Yeah, that was one that I had answered. Remember, I went below and I answered it.
Yes.
So now it's
Jason.
Jason. Yeah.
Jason D. I made an investment in a private equity company that did not pan out. I
hmm
surrendered the shares to a capital loss and got the proper forms to back that up. Can I
Yeah.
file an amended return on U-File for a year I've already processed my tax return on? I'm not sure how to do this and how many years back can I
Back in
apply
you.
this capital loss?
Okay, so Jason, the answer is yes, you can amend. There's two ways you can do it. You could either do what we call a refile of the return, which is through U-File. So essentially, you make the changes to your file, go back to the Net File tab, and there should be an option there for refiling the return. Okay, so that's one way you could do it. Otherwise, you can go directly to the CRA website, which is the My Account portal of the CRA. Go directly there and make your change directly there. Okay, and once you make your and then you can make it directly on the website, and then at that point the government will simply make the change. Now, when there's a loss that is recognized by the government in that current year, you can go backwards 3 years or you carry it forward indefinitely. Okay, that's how the capital losses work. Okay, so you would have to then do another amendment with a specific form called the T1A that you would need to produce in order to carry back the loss to one of the 3 prior years, because that's what you're allowed to do for a loss that you incurred in the current taxation year.
Okay. Next is Denise.
Okay.
Okay, my husband is in a long-term care all 2023.
Yeah.
Can I claim? Do I claim separated or married? And she wants to know, can she deduct the amount of the cost of the long-term care? If so,
Okay,
where?
so first of all, okay, unless there's a breakdown in your relationship, you are still married. What you have right now is what the government will call an involuntary separation. Okay, meaning that you're not physically together, but you're still married. You're still in a conjugal relationship. Okay, at that point. Now, the long-term care facility, absolutely, you're allowed to claim the fees as a medical expense. That's what you're gonna. That's where you're gonna enter it. But remember that those fees, you have to choose between. If your husband is also eligible for disability credit, you have to choose between the disability credit or the long-term care fees. Okay, you can't claim both at the same time. All right. So at that point, when you enter the program usually will default to to the medical fees, I believe. But just double check that just to make sure. Okay. But just remember that it is a choice between either the long-term care fees or the disability tax credit. So if the long-term care fees are substantial, which they usually are, okay, usually it'll be above and beyond what the disability tax credit will be. Then you take off the disability tax credit from the program, and then simply take the long-term care fees. And yes, it is as a medical expense you can claim it. Okay, in this case, and remember that you are involuntarily separated, which depending on the province that you're in could affect certain claims. Okay, so it depends on the province that you're in.
Okay, next question come from Francis.
Perfect.
I have net capital loss in 2022 and would to offset capital gain in 2023 and would like to offset. Okay. Kindly advise how to use U-File to ensure that I can offset.
Okay, so if the loss is recognized by UFile, okay, and has been carried forward by UFile from one year to the next, UFile will apply it automatically. Okay, that's number one. All right, now if you didn't use UFile, for example, in the prior year, and you need to log that loss within there, let's just go and show you in the program. I'll hide you 2 seconds, Ida. And right here, actually, wait, let me see something. Okay, no. Okay, so right now I'm in the software. So in the interview setup, okay, when you go down, you should have carry forward amounts, and you see right here, you got a section called losses of prior years carrybacks. So you tick that box, you click next, okay, and then a section will appear in the left-hand navigator called losses of prior years carrybacks. Okay, click on that as well, and then you can have a section called net capital losses of other years. Okay, so click on the plus sign there. Okay, and then when you click on it, you'll see all the balances of capital losses that you have from the prior years. Be aware that if you filed the return using UFile, this section should already be pre-populated, okay, by the software. Okay, so UFile should have already populated this particular section, and then that's all you need to do. As long as the loss is there, the moment UFile sees the capital gain in the current year, it'll simply apply the losses automatically to reduce your capital gain. Okay, it'll do this automatically for you. All right. And that is back. Magic.
Magic. Yes, it is. Okay, next question is from Caper MJ.
Mhm.
How do I claim my service dog?
So your service dog you would claim under medical expenses. So whatever fees that you incur for the service dog, okay, whether I think it's feeding or something along those lines, and any other maintenance that you would need for your service dog would be claimed under medical expenses. Okay, so that's where you would claim it essentially. Let me just make sure. Just give me 1 second to tell you exactly what kind of fees you can claim for your service dog. Just give me 1 second. I'm just going to go to the medical expenses guide, okay, from the CRA, and tell you essentially what you would need to claim. So let me go to service animals. So service animals, basically the cost of specially trained to assist in coping the impairment. So first of all, the cost of getting the service dog, number one, is a medical expense. Number two, the cost of the animal, the care and maintenance, including food and veterinarian care, are eligible expenses as well. Okay, so and also reasonable travel expenses for the person to take the dog for instruction, for example, and so on. Okay, so that's other fees that can be claimed. And again, this is under medical expenses that you can claim it. Next
Okay.
is Daniel, I believe. Huh?
Daniel,
Yep.
Daniel, is it technically acceptable if, as a landlord in a year where I sold my vehicle, used it for landlord expenses, I wish to indicate I am using a vehicle I bought in a prior year?
Okay. Is it technically acceptable if, as a landlord in a year where I sold my vehicle, used for landlord expenses. I wish to indicate I am using the vehicle I bought in prior year. Yes, you could. It doesn't matter when you sold it, as long as you had a vehicle that you incurred in order to, for example, travel between the different rental properties in order to do maintenance or things like that. You can claim it even though you sold it. Okay, that you can still claim expenses that are eligible. It doesn't matter that you sold it. Of course, you have to indicate though within the rental statement that you did sell the vehicle, because that's something you would have to indicate it. But otherwise, yeah, it is deductible. It doesn't matter whether you sold it or not. Okay, as long as you use the vehicle at some point in the year and you incurred expenses for that vehicle in order to collect your rental income and to do services for those rental properties, you can claim it.
Okay, we're moving to the next question. Jeanette.
Mm-hmm.
I'm a retiree on a pension, and in 2023, I cashed in a 2,600 RSP. Tax deducted was 260.
Yeah.
Beside my pension, OAS, CPP, medical expenses, and the T4 RSP, I have no other tax forms. When I
Yeah.
completed my tax return, it showed that I owed just over $500. When I removed the TR4SP amount, I owe 98. As 260 was already deducted from my original RSP cash
Mm-hmm.
out,
Mm-hmm.
does it make sense that now I would owe an additional $400?
It depends, Jeanette. Again, it's one of these questions where we actually have to look at your file. It's very hard to determine just offhand with just that kind of with that information whether you're supposed to pay that much or not. It depends on the type of income that you have. I don't know how much CPP are you at the maximum at CPP, right? And remember, OAS and CPP, maybe you didn't make any withholdings at source, okay, on those amounts. Now, $260 on $2,600 normally should be enough, ordinarily. Okay, but it might not be based on the fact that with your other income, maybe it jumps you to another bracket. Who knows? It's very hard to determine this. The best thing to do, again, is to contact our support line. Okay, so contact help@ufile.ca and say, this doesn't make sense to me that I'm paying that much more when I've got only 2,600 extra income that I'm declaring, and then from there, the support agent will usually ask you for a copy of your file, and then we can investigate and see what's happening, give you a better explanation.
Okay, Peter. Okay, when someone moves out of Canada, is there anything else that needs to happen with a return other than having sent the CRA the determination of residency status leaving Canada form?
Yes, it depends. Depends on the assets that you still retain in Canada. So, for example, if for example you have brokerage accounts, taxable brokerage accounts, for example. Another example is if you still have real estate in Canada. Okay, these are things that have to be declared at the departure. So you have a specific form, which is the T 1161, or we call it 1161 commonly. So that is the declaration of assets form, where you declare to the CRA at the departure what asset you still retain in Canada, okay, even though you've left the country. Okay, so that's a required form. Otherwise, you pay penalties if you don't declare those assets. And what you declare on those assets is there's some exceptions. For example, your pension plans, you don't declare on those things like cash or personal goods. Like, let's say you still have a vehicle, you still have a car in Canada, you don't declare those kind of assets. But for example, if you have real estate assets, or if you have a brokerage account that is a taxable account, meaning it's not an RSP or TFSA or any other registered account, then these assets have to be declared at the departure. Okay, and this is, again, the form is the T1161. Okay, T1161 is the form that has to be produced with the return. Now, again, depending on the assets, you might be subject to the deemed disposition rules for an immigrant, which we commonly refer to as a departure tax. Okay, it's not, government doesn't call it like that, but it effectively is. And that form is the T1243. And the example of assets that have to be where you have to trigger the deemed disposition is, for example, shares in brokerage accounts that are in taxable accounts. Okay, so you have to trigger a capital gain at fair market value as of the date of departure and pay a tax on it unless you elect to defer to pay the taxation on those assets through another form, which is the T1244. Okay, and then you tell the government, Okay, I'm triggering the deemed disposition. You have to declare these assets. You have to put capital gains, but I'm deferring the taxation of those assets until the day that I actually sell the asset, or if I come back to Canada. Okay, so that's another form that would have to be produced in order to defer the taxation. All these forms are supported by UFile. Okay, UFile will produce all these forms, but these are some of the things that you would have to do. But at a minimum, it's likely you might have to produce a T1161, so 1161, or a T1243, 1243, or a T1244, 1244. Those would be the requirements when you're leaving Canada in this case.
Okay, Sue Bruce,
Mhm.
does UFile calculate the correct carry forward amount for donations?
Yes, supposed to. It's supposed to. It's
If you
supposed
used
to do
UFile
that.
last year,
Yeah, if you use
yes,
UFile in the previous year and in the previous years, then yes, the program will carry forward up to 5 years, of course, because 5 years is the deadline to use up those donations. You can carry forward donations for up to 5 years, but and the program will track those donations for you and will apply them automatically if you can use them to reduce your tax to zero.
and she just asks also, is there a maximum amount that can be carried forward?
No, there's a maximum amount you can claim in the year, and it's usually capped at 75% of your net income. Okay, so a donations claim in the year is 75% of your net income. You can't go above that amount as far as you claim. But as far as the carry forward amount, believe me, on the professional side, I've seen some really crazy carry forward amounts for donations. So no, there's really no limit in how much you can carry forward. But there is, number one, the limit is, like I said, in what you can claim. Number two, it's also how long you can carry forward, and it's 5 years. That's how long you can carry forward.
Okay, Shade is our next question. On the RSP withdrawals, he's going back to what you said before. We
Yeah.
would have to determine which portion was original contribution versus interest. And we now include as income for the year the amount that is the original contribution. Where do we include this income in new file?
So you don't have to determine it, Shade. The financial institution should be able to determine it for you, because the amount that will be included, usually it's a T4A slip, if my memory serves me. It'll be
Correct.
on a T4A slip, and on the T4A slip, the financial institution is supposed to have already determined that for you. So what you see on the slip is the taxable amount. Okay, you're not going to see the other portions that you collected. Okay, that would be tax free in this case.
Okay, next question is from John Smith.
Mm-hmm.
Okay, does UFile support evaluating the need to report a bare trust and any related tax calculations?
No, the answer is no. Because remember, the new filing requirements for a bare trust is on what we call the trust return, which is a T3 return. Okay, it's a completely separate return from the T1. Okay, so now we do have a product on the professional side that you can purchase in order to produce it, which we call DT Max. Okay, and with DT Max, you can actually buy, for example, a license of 2 returns. For example, to produce these bare trusts that would be now subject to the new reporting requirements, but UFile itself does not. Okay, does not support that kind of return. UFile produces T1s and also produces corporate returns, T2s online in this case. You just look up UFile T2 through Google and you can produce corporate returns. Unfortunately, we don't have a UFile version for trust returns, which is the T3 return. But we do offer product on the professional side, which is DT Max. So DT, it's 2 words, DT and then MAX. I'll put it on the chat real quick, and you can simply Google that, DT Max T3, and that's our professional product, which does support the filing of the new, very specifically the T3 return, and specifically Schedule 15 for bare trusts.
Okay, the next question I have, Denise. I believe you answered her. Can I deduct the amount of the cost of long-term care? If so, where?
Mm-hmm,
I
mm-hmm.
believe you said medical expenses.
Yes, I did answer
Okay.
them. Yeah, exactly.
Okay, next one is Meeboob.
Yes.
Hi, where and how do I claim the CCA for my rental condo expenses?
Okay, that one's very, very simple. Okay, let me go ahead and do that. I'll show it on the screen. So item and hide you again. We can still hear you though. So go ahead if you want to talk to us at the same time. Okay, let me add a rental statement right now within UFile. So here we go. Under the interview setup, I've got my rental income section. I tick the box. and I click next, now the rental property income is going to appear right here in my left-hand navigator. Rental property income. I will click on the plus sign on the page to the right, and then you'll notice a new section on the bottom here within the rental section called CCA. Okay, so you click on that, and then you choose the type of asset that you want to depreciate. So for example, is it the building itself? That would be class 1 at 4%. Or is it, for example, a stove, a fridge, furniture? Maybe you're providing furniture to this individual as well that's renting your condo. In that case, it would be class 8 at 20%, which tells you includes equipment and furniture. Okay, so either one, whichever it is you're trying to depreciate, you're simply going to click on it. You're going to click on the plus sign. From there, if it's an addition in the year, you're going to enter it under the additions. Okay, right here, what's called under description amount of the additions. If it's an existing asset, then you should have what we call the UCC, or undepreciated capital cost, at the beginning of the year. You enter the amount there, and then there's nothing else to do. The program by default will claim the CCA amount automatically for you. Okay, it'll take it based on the percentage that is allowable. That's whether it's the building or whether it's the equipment. The program is going to do that automatically. Okay, so there's no there's no issue there. As far you all you need is the value, either the purchase of the rental condo cost, which you put in the additions, or the value of the building at the beginning of the year, which would be the UCC or undepreciated capital cost, and then the program will simply apply it and claim it. All right, and Ida will be back like magic, and there we go. All right.
Thank God I'm still here, right? I didn't disappear.
I know, geez,
Wow. Okay, next question is from Verna. Does autofill complete all sources of income?
Does autofill complete also? No, it does not. For example, business income will not be included in autofill. So if you have a business, for example, if you have rental income, you rent a building out, right? That will not be part of autofill either. What's part of autofill is slips that are emitted by either the government, your employer, or financial institutions. Okay, so whether you're talking about employment income, you're talking about pension income, you're talking about investment income. These are the things that you would see. Welfare payments would be another one that would be included in those. But the two major exceptions, of course, would be what's called self-employment income and rental income, because of course the government has no way of knowing what you made as a self-employed individual, and they have no way of knowing how much you made on your rental. Okay, so those are things that are not included as far as sources of income. Okay, another example would be foreign income. So if, let's say, for example, you made foreign sourced income, that would be another example that the guy. Now, in certain cases, you would get it. So, for example, foreign dividends in a Canadian brokerage account, they would the Canadian financial institution would send you a T5 slip, and you would have them. But if it's a foreign slip, of course, the government would not know, so you wouldn't have that.
Okay. Next question, Peter. If I've used UFile to prepare returns for a few years for two people that have filed as single, and they were married to each other in 2023, is there a way to combine their returns and keep the historical data from previous years and file as married for 2023?
Yeah, no. Ida, you want to answer that one? I think you got this one.
No, you can't. If they're two separate files, you cannot combine them, and there's a lot of reasons for that. Security is one of them. Personal information. So when you create the new file of the new tax year, just simply add her to one of the files. If you use his, add her to his. I think that's the only way, and keep track all the time of the other file. Always keep access to it. So,
all right.
Okay, next one is Ed.
Yeah.
When I try to download a file, I'm getting an error code 051. Do you know why?
I'm assuming AFR. I'm assuming in this case, and I think it's not ready yet. Yeah, and I don't think it's ready yet. Basically, the government hasn't opened their doors yet, I believe, for AFR. I don't think it's available yet because most employers have likely not submitted their slips. I mean, their deadline is today, actually. For most employers and for most financial institutions, they have to submit their slips by today. So chances are that's why you're getting that error code. I'm assuming, Ed. Correct me if I'm wrong. Just add another.
I'll just make a note. If you're using UFile for Windows, make sure you have an update. You update your software.
Yeah, absolutely. Yeah, exactly. But even at that, I don't believe the CRA is up and running. Usually it's the first week of March that we could do AFR, to my
No,
memory at
I
least.
think no, it is
Oh,
open. I
it
think
is
they've
now?
opened it. Yeah, they opened
Okay.
on February 19th, but the
Okay.
information may not be up to date. So if
Yeah.
you're using you filed for Windows, make sure you updated the software
Mm.
or try to use another browser. That's what I'd recommend. My information, Judy, my information on CRA is taking a very long time to upload. Is this normal?
It depends. I mean, it depends on the CRA in this case. It's not really on our end. It would depend on the CRA. If the CRA is slow, like I said, usually I would wait till the first week of March, because that's when all the slips will finally be in to the CRA. Because remember, every institution that has to admit a slip has today as a deadline. Okay, so a lot of them have simply they're actually now doing it at the last second. You'd be amazed how many of them do it at the last second actually to submit all these slips to the CRA. So at that point, I would just wait till next week. And you should. Oh, okay.
What
Sorry, I
happened?
lost. Yeah, I froze there for a second. Sorry,
Okay.
I thought my computer was going was going to crash. So there you go. So just wait till next week. That's what I would say, Judy. Wait till next week, because usually that's when all the slips will finally be in there, and the CRA will be better equipped for the download.
Next question, Catherine. Why do I have to pay twice? If you're talking about the tax return, just send me a message on Messenger. Go to the UFile page and click on Messenger. Send me a message, and we can take a look for that. You probably paid for one return and not two, so that's something we could take care of offline. Next is Pascal.
Okay.
How to file an NR4 slip.
Okay, so the NR4 slip, it's you're essentially that whoever that person is considered a non-resident that has collected Canadian sourced income. In this case, it depends on the type of income that they have. An NR4 slip, ordinarily they've already paid their tax, so you would not be producing a return necessarily for this person unless they want to produce what we call elective returns, which is either if it's rental income or pension income. Then individuals who have non-residents who have collected Canadian rental income or Canadian pension income have the right to produce Canadian returns in order to, instead of paying what they call the non-resident tax, which is, in legal terms, Part 13 tax, which is at a flat rate of 25%, they can choose to pay tax at the same tax rates as any other resident of Canada. And these are under special elective returns, which we call Section 216 for rentals and Section 217 for pension income. So unless you're producing one of those returns, you're not going to be filing the NR4. Okay, now let me just assume here that you would be producing one of those forms, one of those elective returns. Then you check the income code that's on the NR4 to double check what type of income is declared on the NR4, because the NR4 could be anything. It could be rental income, it could be investment income, it could be pension income. So, for example, if you're producing a Section 217, which would be pension income in this case, then you check the income code. If it's an RSP income, for example, if the income code tells you it's RSP income, you would enter it under the equivalent slip for Canadian resident, which would mean a T4 RSP. If it's RIF income, you would be using a T4 RIF as a slip. If it's OAS, you're entering it under a T4A OAS, and so on. Okay, so you have to check the income code and then use the equivalent Canadian slip to enter that particular amount. Okay, that's how it would work. That's how it would work in this case for the NR4 slip. But remember, they've already met their tax obligation with the Canadian government with a non-resident tax. Only in the cases where you're filing either a Section 216 or a Section 217 are you actually filing a return, and these are only elective returns. You're not required to file them. So make sure. So I just wanted to clarify that.
Okay, next question, Teresa. How do we claim working from home expense?
Okay, so Teresa, that would be under employment expenses. Okay, that's where you would go. So let me just show you real quick on the screen what section you need to add. So I'm going to hide you again. Let's go over here. So under the interview setup, okay, when you go under the interview setup in the employment and other benefits section, you're going to see a section called employment expenses. So tick the box next to employment expenses, click next, at the bottom of the screen. And then in your navigator, okay, your left-hand navigator, just below the T4 and employment income, you're going to have employment expenses. Okay. And under employment expenses, you have to choose between salary or commission, depending on which one it is. Okay. In your case. And then from there, once you click, let's say on salary, you're going to see at that point a section within employment expenses called home office expenses. Okay. So from there, you simply click home office expenses and then you make your claim right there. Okay. Remember that this year, the flat rate method that was there in the last 2 years is gone. Okay. The government no longer allows for the flat rate method, which is a $2 a day deduction that if you were required to work from home due to COVID. Okay. So that is gone now. You could only go with what the government calls now the detailed method, which is you have to have these type of expenses in order to be eligible as eligible expenses for home office expenses. All right, we're going to bring Ida back.
And we have to remember that the simplified method is no longer available for the work from home, the $2 a day.
What's that? Sorry, can you repeat that? I'm sorry. I missed that. Sorry, I was looking at the questions. No, okay. I was not. I was just looking at the next question, and I'm preparing. I didn't hear
the work from home expenses.
You need a certificate, right?
Yes, but the $2 a day method, the simplified method, is no longer available.
No, that's what I just said, actually. Is to see you weren't listening to me now, because that's exactly what I said. I said the flat rate method is no longer there. There you go. Turn the tables.
I was thinking of simplified. Okay, next is from David. How do I claim a major loss on a stock sale?
In capital gains, you will go into the capital gains section, and then you would choose, usually it would be stock and other non-depreciable property is the category within the capital gains section. And then from there, you enter your transaction, whatever it is, and then the program will claim the capital loss on the return. It's as simple as that.
Next question is, I'm not going to pronounce the name because I know I'm going to say it wrong. So
okay.
What is CCA? And I know Viola put an answer, but can you elaborate on it?
Yeah. So actually, I'll just show Viola's answer at the same time. Why not? Because I think she did get the answer properly.
Yeah.
CRS told me that you don't have to use CCA. Yeah. So essentially, CCA, essentially what it is, the terminology, the acronym is called capital cost allowance. What it means in non-legalese, in non-taxonese, it means depreciation expense. Okay, so essentially CCA is that whatever asset you're buying, whether it's a building, whether it's a car, whether it's a computer, whether it's a desk, okay, these are equipment that are long-lasting, meaning the government considers them as a capital expense. So you can't take the full expense right away, but you're allowed to depreciate it, meaning that you are taking an expense for the loss of value of that property every single year that you're using it. Okay, that's essentially what CCA is just the tax term for depreciation expense that we call an accounting-wise depreciation expense. Okay, that's essentially what it is.
Okay, next question, Verna. Okay, thank you, Catherine. No, sorry.
No,
Jason?
It's Matthew. No, Jason is answering the other question.
Matthew.
Yeah.
Work at home expenses. Do you need a form from your employer since the simplified method is not available?
Yes. So that's what I mentioned before when somebody was asking me what was the difference between the T2200 and the T777. So the answer is yes. From now on, the flat rate method is gone, where you didn't require a certificate essentially from your employer, or what we call the conditions of employment. Okay. So now you need that conditions of employment. It's the T2200 form that you need. It has to be signed off by your employer, confirming, okay, that you are, as part of your work contract, you are required to work from home. Okay, so the moment you have that, now you are eligible to claim home office expenses on your tax return. Okay, but you need that form. Otherwise, you're not allowed to claim those home office expenses, and you go under what we call the detailed method now, meaning that now you are actually listing your expenses. Okay, and the eligible expenses, basically, you're talking about utilities, you're talking about home internet, you're talking about rent, and if you're a commissioned salesperson, you could also add property taxes, and you could also also add, for example, property insurance. Okay, but this is only in this case if you are a commission income employee. Okay, you could claim those expenses. Remember that your expenses are prorated based on the square footage of your home office vis-a-vis the rest of your home. So, for example, you have a dedicated room. Let's say you have one bedroom that is purely your home office. In this case, then you take the square footage of that room divided by the square footage of the total of the home, and then that whatever percentage that comes out to is the percentage you're allowed to claim for those expenses.
Okay, Jason, if I have a child with a recognized disability, autism, would a live-in housekeeper nanny be considered tax deductible? That's a good question.
So, a question that you could claim it theoretically under attendant care. Okay, so you would be able to claim it under an attendant care. That would usually be medical expenses. It would be a deduction if the attendant is allowing you to work, okay, due to your disability. But this would not be the case for your child. So, for your child, in this case, it would be attendant care, and this would be under medical expenses. Now, remember now, for attendant care, there's going to be a limitation. Okay, it's either you claim the disability credit and $10,000 of attendant care, or you claim fully the attendant care expenses under medical expenses. And usually that's the one that's going to win out because, it's very expensive to have somebody specialized under attendant care in order to claim it. Now, the key is, though, it can't just be a housekeeper kind of thing. It's got to be somebody who's helping the child with their everyday activities, okay, with their everyday functions, okay? It can't just be somebody who's just cleaning the house or cleaning the rooms or stuff like that, okay? It's got to be really somebody specialized who is helping that person with their daily activities, okay? That's when you could claim it under attendant care.
Okay, Matthew, are investing deductions like interest payments, advisors' fees, etc., deductible against capital gains or just other forms of income?
You would ordinarily, the investment, well, first of all, the investment has to be in a taxable account. Let's make that clear. A lot of people always have that mistake that they think they could claim, for example, these type of fees for, like registered accounts like RRSP or TFSAs. Not the case. They're not deductible in that case. If it's for a taxable account, ordinarily what the law tells us is that it has to produce income, meaning that it is interest or dividends. So if you own, for example, shares that create dividends and that pay out dividends, then you meet the criteria of carrying charges or investment expenses. And then you can deduct them again as long as they're in a taxable account. But the key, though, is that they have to produce income, meaning that it's either interest income or producing dividend income as well.
Okay, next question. How do I use UFile on my iPad?
Ida, you want to grab that one?
It's always best on on a laptop because the iPad, you sort of, it gets cut off a little bit. So I would recommend an iPad, a computer.
You could do it though, as long as you use
Yeah.
a browser. I mean, the key is as long as you use a browser. Like you can't use the installed version, obviously, because that's only Windows. Okay, it's only compatible with Windows. But our UFile Online product, you could, as long as you've got the browser running, you could use it with your browser. It's gonna be a little bit more tedious because it's more designed for like a mouse, in this case, than really touching. But you can use it. It is
If you use
capable.
autofill, that does help too.
Yes, absolutely. Yeah, absolutely. Okay, so I think we're already at time. Let's do the one last question that's there,
Yes.
and then we're gonna be done.
Okay, the next one is Bobby.
Hmm.
My dad was on dialysis before, and my doctor told me to file that my dad is disabled, but he undergone surgery transplant last year, and any changes? Sorry, I get a pop up right now. Sorry.
Okay.
Any changes or form do I need to submit?
Um, okay, well, I'm assuming because remember to claim disability, your doctor had to have signed off on the official disability certificate, which is the T2201 or T2201, as we call it within tax circles. Okay, so ordinarily you would have had that form already submitted to the government. If your father is no longer considered disabled, then you have to make an amendment to the CRA. You'd have to contact them in that case. It's rare that you undo a disability claim, right? It's very, very rare. So your best bet is to contact the CRA directly and find out how you would undo that if your father's no longer considered as disabled in this case.
Okay.
I think that's it, huh? We don't
I
have
think
any
that's
other.
it.
Yeah, I think we got through all of them. All right, just in time. Awesome.
Great. So this concludes actually the session, our Q&A session. Jerry, any dates you want to remind us? And
Yeah, sure. So today, remember RSP deadline. You must fund your RSP account today. Otherwise, it'll in order for it to count for the previous taxation year, so 2023. The deadline for filing your return is April 30th. Okay, always remember that that's the deadline that you must submit your return. If you're self-employed, you've got until June 15th. I think June 15th falls on a weekend, so it could be the next Monday. Okay, I believe. Don't quote me on it though. I don't have a calendar in front of me, but essentially those are the important dates. Be mindful that as well through we have also our webpage, which is ufile.ca, where, for example, lately we've posted all the tax changes that are coming within the 2023 return. Okay, and then make sure that you read them, that you're not missing out on anything that the government has added for the current year. We also have our YouTube page where we've got a lot of instructional videos on how to use the software. We're about to add a bunch of videos on some of these new tax changes that are coming, so we're going to show you how to input them in the software. Okay, and we also have some tax educational videos. We also have a podcast. Okay, so where me and Ida have this nice fireside chat. No, maybe not fireside, but we have a nice chat every single time where we talk about different topics. Like the last one we did now was for tax changes. Is about to be posted. It's already posted on the audio podcast. Whether you go to Apple Music or Google Podcast or any other or sound or SoundCloud, etc. Okay, so everything is there. Okay, so again, we always post these things. We post them for free. We try to give you as much information as possible. We try to educate you as much as possible on the wonderful world of taxation. So be sure to use those resources that we provide. We provide them for free. We don't ask for anything. And there you go. Yeah, so I think we just got the question whether we're going to do this live again. Yes, we should be doing another 2 or 3 this year live. So just like the page so that you get notification of when we're going to do our next live session.
yeah, we
Okay,
need to
thank
discuss
you,
that.
Lana.
All right. So
Yeah,
thank you, everybody. And this concludes our live session. So have a great afternoon. Thank you.
take care, everybody.
Bye.
All right.